Hey, what's up? This is J. Lucky Henry, Keller Williams agent in the greater Boston area. And this video is about the top 10 most common questions around pre-approval. See, every year, my office helps hundreds of people buy properties, and we always get tons of questions around the pre-approval process. So I got 2 loan officers who've done tons of pre-approvals, tons of offers, and I got them to walk and talk. So we hit the streets, and they brought their most commonly asked questions from their clients. I brought our most commonly asked questions, and we made this top 10 list just for you. It's gonna cover things like, what if you're self-employed? What if you have bad credit? Well, how do you get the best rate? All those and more in this list. If you like this type of content, click that like button below on this video, subscribe to my channel for more, and get ready.
Just try to maybe use some of the money you have saved up, because if you put that on your credit card, now your pre-approval could change because your liability, your monthly payments are going to be a little bit higher than before, which could hurt the amount that you can actually get pre-approved for. So
it's definitely beneficial to get a pre-approval done on the front end before you start looking at places, because if you don't know what the limit is and what you can afford, you know, how do you know if a place that's $400,000 is good, but if you can afford $500,000?
So the first question we're going to cover today is something that a lot of people have a misconception about. They think that if they try to get a pre-approval, they have to hence ding their credit, and by dinging their credit, they're actually lowering their credit. So they're kind of scared to check to see what their credit is. But then if you don't check, how can you know?
the government basically allows consumers in this country to pull their credit a couple times when looking for a mortgage rate. Now, it does hurt your credit if you're pulling it multiple times trying to apply for like a credit card, but you can actually check in with a couple different banks to see, just to make sure you're getting the best interest rate. So the credit bureaus actually allow you to pull your credit a couple times for a mortgage rate.
Oh, those credit bureaus. They're so powerful.
Yes, they are.
Okay, so you understand. It's not all bad if you check your credit once or twice. Now, what is the difference between really hard inquiries on your credit report versus soft inquiries? And yeah, I said it different 2 times. So what? Tomato, tomato, right? But pre-approval versus pre-qualification. Is there a difference? Do you know the difference? And does it matter when you're going out there trying to purchase a property if you have a pre-qualification versus a pre-approval? Let the experts explain that as well.
So a pre-qualification is just a very simple inquiry into somebody's credit history.
Okay. Now, so what's a pre-approval?
A pre-approval is even stronger. So a pre-approval is what we prefer to do in my office. We like to do a real hard look into your credit. I want to gather some tax documentation, want to gather some income documents, even look at your bank statements, so that way we know there's nothing hiding anywhere in the loan.
So you said you want to what? You want to gather my bank statements and then what?
So we want to gather your bank statements. We want to look at your last 30 days of pay stubs, and I'd even like to look at the last 2 years of your tax returns. That way when we issue a pre-approval, we know there's nothing that could be hiding inside the loan that could keep you from getting it.
Okay. So you're starting to understand a little bit more and more about this process. You understand now the difference between pre-approval and pre-qualification. Now let's say, and how they relate to affecting your credit. Now let's say you don't have stellar credit, right? Your credit isn't perfect. You don't have a perfect score. Maybe, I don't know, doesn't matter. Your situation's your situation. Does that mean you can't get pre-approved? Does that mean getting a loan to buy the house of your dreams is completely out of the question for you? Well, this is a very important question and a very oftenly asked question, so I decided to let both of them answer this one for you. Check this out.
You don't have to have a phenomenal credit score. You can have credit card debt. You can have liabilities and a car payment and student loans, like you mentioned, and still be able to get pre-approved and get a mortgage. And not only can you do that, but it still might be cost effective to do so. So just because you don't have immaculate credit and you have some credit card debt and some liabilities or some student loans, that's not necessarily a deteriorating factor when coming to get a mortgage.
Got it. Okay.
Every case is a little bit different, but we work with some lenders that are really willing to help just about anybody. So you can definitely go even below a 580 credit score now and still purchase a new home through the FHA. Obviously, student loans, it's a challenge for a lot of people. We actually only need to use 1% of what your minimum payment is in your debt to income ratio. So let's say if you're making $500 in payments a month, we actually only need to use $50 against you as a liability. So they passed that guideline. Just helps a lot more students who have a lot of student loans be able to actually buy a property.
Good stuff, right? Very important. I know a lot of people who have sat down with and initially thought there was no way they could purchase. They decided the only option they had was renting because their credit wasn't right. But after sitting down with these officers, they're able to understand the process a little bit more and understand that buying a home might not be so far out of the realm of possibility. So if you've been watching this video this far, I'm assuming you like it. So if you do like the content I'm putting out, I'm going to ask you now to go ahead and hit that like button down there on the video, and let's keep rolling along. So the next question we went on and asked was, what if you get pre-approved for X amount? Maybe let's say it's $500,000, but the house you want to buy doesn't cost $500,000. Are you required to spend $500,000 because that's what you got pre-approved for, or could you spend less? Could you spend more? Well, I can tell you the answer to one. Unless you got the difference, you're not spending more. But let's find out what happens if you do buy something below your means.
Yeah, so how that would work is if you've been approved for a $400,000 home, let's say.
Yep.
And the asking price is $380,000 and you make an offer of $380,000.
Okay.
We can produce a pre-approval letter for that amount because it's under the total limit that you are able to get borrowed.
Got it.
Get money from. So you don't want to show your cards sometimes.
Yep.
That's kind of what the message is. So when you do a pre-approval letter, you never want to show the selling agents or the sellers what your total amount is that you're able to get approved for. You only want to be strategic with your real estate agent to determine, based on this house, this is what we're willing to put down and make an offer on, as opposed to showing your entire limit that you've been approved for.
Makes sense. I love it. I love it. Hey, you're still here. You're still watching. That means so far you still like the content, still like the video, and you might even like these loan officers. Now, in the real world, perhaps for some odd reason, you might have chosen a real estate agent who's not me. And that real estate agent might have introduced you to a loan officer who's not one of these two. And then what happens if that loan officer produces a pre-approval letter for you, but then you find out you really don't like this guy or this gal. You don't like this person. You guys don't get along. What do you do then? If I get a pre-approval letter from a loan guy, but then I find out I don't really like him. Maybe he's too tall and my hand hurts, right? When I shoot videos with him.
Don't like him.
But if I get a pre-approval letter from one guy, am I stuck with this guy now, or can I switch loan officers after that point?
Sure. So in 2008, there was a big market crash and everything went down, and there was a lot of changes to legislation, Lucky. And with those changes is everybody made it a lot easier to expose what the rate is, to show and disclose exactly what is going on with the mortgage to the borrower. So to answer your question, if you get pre-approved with one loan officer and another loan officer or mortgage broker you feel you have a better relationship with, he takes care of you and he delivers a phenomenal rate and can hold themselves to that rate, you can absolutely use whoever you want to, even if you've been pre-approved with one loan officer versus another.
Cool. So we understand that we're not stuck with a loan officer just because we got a pre-approval letter. Later down the line, once we actually have the loan, yeah, we might be kind of stuck with that person. Unless we get into refinancing, but that's a whole nother video, okay? Stay tuned, subscribe to my channel if you want continual education on real estate. We talk about everything here. So the next thing we went and we asked them was, what exactly are points? And how does that relate to my interest rate?
So points are basically, it gives you the ability to buy your rate down if you would like. Typically when I pre-approve a client, we do it with no points because points usually aren't a really good decision from a financial standpoint. But basically if you're approved at a 4.5% and you want to get a 4.25, the government will allow you to pay X amount of thousands of dollars called points to basically buy your rate down. Wow. Not mudslinging against the big banks, but a lot of times they will roll points automatically into somebody's closing cost so that they think they're actually getting a really good rate, but in fact, they're paying $3,000 to $5,000 in points to get that rate.
Got it. Interesting. Does that work on people with like less than stellar credit?
It really.
If I have let's say I have not decent credit, but I have more cash available. Can I lower my interest rate?
Yeah,
by putting more
anybody
at the
can.
closing?
Yeah, anybody can. So it's basically a government guideline now. Anybody can buy their rate down. As well as the other side of that coin is what is a credit. You can also take a little bit of a higher rate to get some credit towards your closing costs. So if a client might be short a little bit of money on their closing costs, they might take a little bit of a higher rate and get, let's say, a $2,500 credit towards their closing costs. So the government will let you take a higher rate to get some money from the bank, or you can pay money to buy your rate down and get a lower rate.
One thing I love about real estate is it's never TMI. There's never too much information. Like, the more you learn, the more capable you are of doing things in your life and creating freedom for yourself and being able to purchase the homes you want. So most people will only buy 2 or 3 homes in their lifetime, but when you do buy those homes, you want to be the most informed person in the room, or the most informed person that you can be about this transaction, because these are big deals. So it's never TMI, but we are going to talk about a different acronym, and that's called PMI. And I'm going to let my man explain exactly what that is.
It's not PTI. So PMI is an acronym for private mortgage insurance.
Private mortgage insurance.
So basically, after the crash in 08 and 09, any mortgage that's written in this country now, unless you put down 20%, it always carries some type of private mortgage insurance to protect basically the economy from people foreclosing on their homes.
Oh.
No, so I'm going to have PMI if I put down less than 20%.
Correct. But there's a lot of new programs out for people that have a stronger credit profile. We're actually able to go as low as 3% down to actually have the lender pick up the PMI on a monthly basis, so that, again, based on your credit profile, you can put down as little as 3% and actually have no PMI. It's just all based on your credit profile.
Nice.
Yeah.
Remember earlier when we were talking about points and credits and getting a good rate, etc.? So let's say you got a stellar profile and the market's doing its thing, so you have a great interest rate, and you're worried that you might lose this interest rate because it's just too good to be true. It's a phenomenal rate. How can you guarantee that you keep that rate? There's a word that describes that, and it's called a lock rate.
The lock rate is basically if somebody says, hey, we're giving you a 4.875% interest rate. There's different lock periods, typically 30 days, 45 days, and 60 days. That means you have that rate no matter what happens in the market. So if you're going to close on a certain date, it's part of my job is to watch the market and see when is the best time to lock your rate so that I can get you the best deal and make sure that your rate is good until we're closing.
Cool. So now you understand the lock rate. And here's another topic we're going to talk about, and this is a huge one for all my entrepreneurial friends, all my people who get out there and take control of their future, right? How do you get pre-approved? Because let's face it, not all of us who are self-employed have that payroll salary that we put ourselves on yet. Not all of our businesses are mature to that point. Some of us just perhaps take a draw from our company every now and then. How does someone like us get pre-approved in these situations? Check this description out.
There's a lot of restrictions on that nowadays. Before the crash, there was just a lot of fraud going on with self-employed borrowers. So basically now what the government guidelines are is you need to show the previous 24 months of being in that self-employed business role. And then what they're going to do is basically take an average of the last 2 years of what you've made, of what you've reported to make, and that's what we're going to be able to use to pre-approve you.
So 24 months, 2 years of my tax returns basically, and then average out to a monthly income and use that for a debt to income ratio.
Correct. Yep, absolutely, 100%.
Now and this is actually a question for me.
Yeah.
Now can if I'm incorporated as a business and all I'm doing, let's say, is pulling profits from my business, I don't actually have a salary, are we going to use the business now as a pre-approval, or are we going to use what I'm drawing as profits?
So we're going to use basically whatever on your tax returns you're showing up on either your Schedule C or Schedule E is basically your net profit or losses. Ooh. So if you're making $100K, but you're writing off $80,000 in business expenses, then we can only use $20,000 to keep it simple.
One of the reasons I'm so passionate about real estate is because the moment you decide to own property, whether it's your own house or an investment property, you're becoming entrepreneurial. You're taking control of your financial freedom. Whether you think so or not, you are becoming in control because you now have assets that are appreciating. And some people do this individually. They just buy their homes and it appreciates in value and then they sell it later. That's an entrepreneurial move. some people get together with a group of friends and want to buy multiple properties and rent them out or flip these properties, entrepreneurial moves. And one of the questions is, when you want to get into that space where you're really doing this as expressly as an entrepreneurial move, where you're buying maybe with a group of friends, can you get a mortgage among the 3 of you, the 2 of you, the 7 of you, or can only one person get a mortgage? So there's a difference between co-borrowers and co-signers, and we're gonna let the experts explain that difference to you.
They want to buy a multifamily, a single family, whatever it is. They want to buy. They're tired of renting. You know what? They've listened to your advice. They said, Mr. Salmons, I'm tired of renting. I want to actually get a place that we can own. So how would that work? Would they have to be co-signers? Could they co-borrow money? How do 2 people get this done?
Right, so there's a difference between a co-borrower and a co-signer. So to your point, if for whatever reason you might not have a great credit score, or you might not have enough assets to get the limit of a loan that you want, you can add a co-borrower. And a co-borrower has just as much liability on the mortgage as the original borrower. So when that happens, they have the capabilities to add somebody to the loan, so you can add 2 assets, 2 incomes, 2 credit scores to potentially get a bigger loan.
Got it.
So if you don't have a perfect credit, or you don't have enough for the down payment you want to put down, or enough income to show, you can add a co-borrower to the loan to increase your limits of getting approved.
Okay, and that's different because a co-signer just kind of, it's kind of like the backup plan?
Yeah, a co-signer essentially doesn't have all the responsibilities that a co-borrower does, but a co-signer isn't responsible for the mortgage, but they're responsible to help pay off the monthly mortgage after the mortgage is complete. So they're still on the hook to help pay for the mortgage after it's been set up and designed.
Got it.
I hope this video was helpful. I hope all these 10 tips help you understand a little bit more about the pre-approval process. Do me a favor, comment below. Let me know which one of these was most helpful to you. And if you have a question that we didn't answer, please comment that below, and I will make sure to go through the comments, find that comment, and answer that question as best as possible, right? Now, last thing I want to do before you guys head out is, I did ask both of these loan officers, I appreciate them taking their time, and I asked them to tell you just a little bit about them and what makes them a great loan officer for you to do business with. And this is really short. They're just going to tell you what kind of separates them from other loan officers. Take a quick look.
So, that's a good question, Lucky. I would say that because there's so many loan officers and brokers out there to work with, and I think it's important that a lot of loan officers will just send you an application and tell you to fill it out and have you send them all the required financial information that they need, when I think if it's done right, the loan officer will actually sit down, meet with the borrower, get to know them, fill out the application with them, because some of those questions on there, they might not know, or they might get intimidated to answer when it asks for certain things. So having somebody actually walk you through it step by step, I think is important, so they feel comfortable. People don't like doing anything unless they're informed and they feel comfortable. So I think that's a big difference when working with a loan officer. Make sure they're giving you personal attention and doing everything with you, not telling you to send them documents and get things back to them.
Got it. That makes sense.
For me, it's truly just answering my phone. It might sound like a cliche, but being a veteran myself, I seem to deal with a lot of first responders and nurses and firefighters who have wacky schedules. I just pick up my phone. If it's Saturday afternoon and a client's stressed out about the mortgage question, my clients know they can call me or shoot me a text, and I'll answer that question for them. I really feel like it's that, and then just loving what I do, and realizing that I do this every single day. Most people are going to buy a home 2 or 3 times in their life, so I always try to remember that this is actually a fun experience for people. In order to keep it a fun experience for them, my job is to answer my phone, answer those questions, so that they're not having that horror story of, oh, my friend, it was a horror, I have to get so much paperwork in. It was just a stressful process. So I just try to remember that people are most likely going to do this a couple times in their life, so I try to keep that in the back of my mind always, and keep it fun for them.
Awesome, I love it. Fun, you know what it's about. So I like it. Thank you for your service.
Very welcome.
Well.
Thank you, I appreciate that.
And hey, it's Matt DeShaughness, J. Lucky Henry, Superior Rate Mortgage, Keller Williams. We'll put the little banner so you don't get us confused. I know, because we look too good looking, you might get it mixed up. Hope this was fun. Subscribe to my channel if you haven't. Like, comment, share this video with a friend, someone you think this might benefit them to know this information. And be back every day for more Real Estate Explained.